Hi there, my name's David Allingham and I'm a portfolio manager at Ely Griffiths Group. It gives me great pleasure to be able to present our new strategy to you today, and I hope you enjoy the presentation. So just a reminder for people who are less familiar with Ely Griffiths Group, we were founded in 2003 and in fact our flagship fund turned 20 years old in September of this year. We've got an investment process that's been tested through many market conditions. Our flagship small companies fund has delivered close to 10% per annum after all fees for 20 years, and our emerging companies fund that we launched back in 2017 has delivered 13.8% per annum after fees. And importantly, the last point on this slide is we are a style agnostic manager, which means we're not anchored by either growth or value styles. Just quickly on the team, you'll be very familiar with Ben Griffiths, the founder of Ely Griffiths Group. He's complemented by myself, Tim Sargent and Nick Goodyear as portfolio managers. And of course, we also have Peter Saltz, Sean Kirwan and Lachlan Dowge, making us a 7-person investment team with complementary skill sets and a diverse range of capabilities that ensures we don't get stuck with groupthink. We're continually stress testing our ideas. And I guess on page 5 here, the case for active management. Well, our small companies fund, you can see here, has delivered a $10,000 investment back in 2003, is now worth $65,000 in fact, post all fees 20 years later versus the market that has only delivered around $30,000 pre-fees in fact. And our emerging companies fund has delivered a $10,000 investment is worth $24,000 today versus the market at around $14,000. So again, a very strong case for finding a manager and for their economics in actually paying active management fees. So I'm here today to talk about the launch of our new mid-cap strategy. This has been a number of years in the process, and we had a blank canvas as far as product design, and we've thought very carefully about this fund to ensure that it's a fund for the future. So let's go through a few of those features. The fund will be for retail and wholesale investors, minimum investment of only $25,000. It'll be a unit trust structure with daily unit pricing. The product design will have the below features, so significant investments from staff on the day of launch, a universe that will reside outside the ASX 20, and a portfolio holdings of 25 to 45 stocks in totality. So you should be thinking of around a typical portfolio will be around 35 stocks. That'll be roughly 20 of the best mid-cap names, complemented with our highest conviction 15 names from small caps. And we believe if we bring those two pools of stocks together into a portfolio, we really weed out the mid and tail that can be a drag on performance. We end up with 2 pools of high performing stocks in one fund. I guess the average market cap typically will be around $6 to $7 billion, so you're talking about well-established businesses, and a maximum position size or active position size of around 7%. Tim Sargent and myself will be the daily portfolio managers on this fund, and the benchmark will be 70% mid-caps, 30% small caps. Most importantly, the fund fee structure we have designed to really ensure the best chance of us delivering after fee performance to investors. And so we have struck a flat fee structure with no performance fee, so a total fee of 1.05% inclusive of all GST. Equity Trustees is the responsible entity, and Apex will be providing the fund administration. So I guess why are we launching mid-caps? And it's an important question to answer. I guess the very short answer to that is that mid-caps are the most attractive part for absolute returns in the market. And you can see on the chart on the right here with the columns that the ASX 50 mid-cap has delivered 10.1% compound return since March of 2000. Well over 20 years at 10.1% compound versus the small ordinaries on the far right at only 4.9%. And you can see the red column there, our blended benchmark that we'll be looking to outperform has delivered about 8.6% per annum over that 20-year period. And you can see the power of the compounding that delivers that outperformance in this part of the market via the orange line here, where that outperformance is so stark versus both big caps and small caps. So we've identified mid caps as a very favourable part of the market. And I guess why do they perform so well over time? And there's a few theories for that, but one of them is clearly that 88% of all mid-caps are profitable. So you're dealing with companies that are more established, they have higher barriers to entry, they've grown up through their small cap heritage and actually graduated into the larger part of the market. And so the barriers to entry are high, established profitable businesses, greater governance, there's more liquidity. And we've got a chart here referring to the Zenith report that showed they are really in that sort of sweet spot for risk-reward equations. The x-axis shows here the risk profile as you go from large into mid and into small. That risk profile increases, but so does the return profile on the y-axis. And clearly mid-caps are right in the sweet spot there. And a couple of the household brands you'd be familiar with. These are the kind of stocks you'd expect to see in our new portfolio. This is a blend of some well-known mid-cap brands and businesses, but also some of the high-conviction small-cap names. So the likes of Cleanaway, WiseTech and Worley, Xero, these are classic mid-cap names, but of course names like Breville and Domino's and car sales are also part of that small-cap mix where they're going to complement the mid-cap part of the portfolio. Okay, well let's turn to the Eley Griffiths Group approach to mid-caps. What are we doing that's different in this strategy? And I guess most importantly, we really believe that a small cap manager moving into the mid cap space is an enormous competitive advantage. We have owned greater than 50% of these stocks in recent years. So we have an extraordinary familiarity and with the qualitative aspects of these businesses, often dating back to IPO. And that includes governance, acquisitions, how they've traded, mistakes they've made. The second point here is we are genuinely a style agnostic manager. We have a 20-year return profile for our small companies fund that has demonstrated style agnostic returns. That means we're not anchored to either growth or value. We are flexible, we adapt as the data changes and our portfolio will move within the underlying earnings in the market. We have a strong capability, but not just strong, it's also diverse. And you need a diverse capability to outperform this very high performing part of the market. And a good example of that is having a resource capability, and we'll touch on that in a moment. Also, we'll be leveraging the existing investment team, the 7-strong investment team, but also the same investment process that's worked throughout our 20-year history. And finally, it's been very important for us to get the product design right. We've had a blank canvas to really set the record straight for this new fund that's going to be relevant in 7, 10, 15 years to come. And a big part of that is getting the fee structure right. We really want to ensure that we're delivering after fee outperformance. And we think a flat fee structure with no performance fee, a total of 1.05% per annum, all inclusive of GST, is a very competitive solution that will give us the best chance of outperforming after fees. And on top of that, we want to ensure we don't raise too much money. We want to keep this small, nimble, and so we're launching with a performance-first approach to capacity management. So let's look at extending the small cap journey. That's what we're here to do today with this new strategy. This chart shows a handful of stocks and their charts as they've gone from small caps into mid caps. Eley Griffiths Group to date, in its 20-year history, has only been monetising stocks that have resided on the left side of this red line. Today, with the launch of our new fund, we will be monetising not only the stocks on the left, but we'll also be continuing to monetise these stocks as they graduate to the right into the mid-cap territory. And we think building a portfolio that brings the best of both sides of this chart together is going to be very compelling for investors. But importantly, they're not all straight line 45-degree up charts, as you can see. Some of these stocks that graduate to mid-caps do fail, and that really justifies the need for active management in this space. And so turning to what style agnostic is and what we stand for and why calendar 22 was such an important case study as a style agnostic manager. Importantly, we did change our portfolio in calendar 22 and that's reflected in our return profile for that year, which we're very happy with. So what changed? I guess when you look back on 22, you really had to be underweight technology and overweight energy. And pleasingly, that's what our portfolio demonstrated for our existing investors in our small companies fund. As you can see here on the left, why did we change? Well, to be very blunt, the outlook for the energy sector's earnings changed. And you can see that on the left here. This is the forward-looking 3-year earnings growth for each sector, tech versus energy. And what changed as we got to June 2021, it was very clearly energy's earnings growth accelerated dramatically versus technology. And that was the change you needed to pick up in portfolios if you're a style agnostic manager. And pleasingly, on the right there, you can see our small company strategy, which had been underweight energy by 3% and overweight tech, we did make a change as the data changed. And as you can see, by June 2022, our portfolio was 4% overweight energy and underweight tech. And that's what we will be looking to replicate, these kind of dynamic changes in the portfolio through the life cycle of this new strategy. And we also mentioned that you've got to have a diverse skill set or a diverse capability to outperform this very high performing part of the market. And I guess the chart on the right here shows you why. This is the GIC sector breakdown of the 70% mids, 30% smalls benchmark that we'll be looking to outperform. And we've circled here materials or resources. They make up 25% of the actual benchmark. So to really give yourself a proper chance of outperforming this part of the market, you've got to have a resource capability. We know now that the resource market's clearly got a more level playing field as far as its outlook, whether that's a supply side issues we all know about, or whether it's the decarbonisation battery metals complex. So having a resource capability is very very important. But equally, energy is also close to 10% of the market in this part of the benchmark. So you can see that almost 35% of the total benchmark is resources and energy and materials. And if you're not able to do that, it's very hard to outperform this market through the cycle. But I guess the backbone to doing all this is our investment process. And this is the same investment process we've deployed for 20 years at Ely Griffiths Group. It's effectively a relative stock scoring process where we score every stock in the universe. Half of its total score is based on a quantitative profile, so the price you're paying for the company's earnings per share growth. And the other half of the stock assessment is effectively a qualitative score. And that's based on management track record, capital management within the business, strategic plan, and alignment with minority shareholders, but also looking at industry structure via Michael Porter's industry forces. We combine those two sort of factors into a total stock score. We standardise those scores, and no surprise that the highest portfolio weight is allocated to the best scoring stocks. And we build a portfolio, in this case, of 25 to 45 high conviction mid-small cap names. So just to summarise, thanks for your attention. Just a reminder, Ely Griffiths Group is 100% owned by its staff. The key investment decision makers own the business. We are also heavily invested in the funds. We run risk control measures at both the stock and a portfolio level, and we've got 20 years of history of doing that. We've got an organisation that has scale and relevance, which is important. We get out and see a lot of companies throughout a financial year, upward of 800 company visits per annum. Our investment process, which I touched on briefly, is the backbone to our portfolio construction process, and it'll be deployed for this new fund. And of course, I touched on the importance of knowing what your identity is as a manager, when you're going to outperform, when you're going to underperform, and what you expect to deliver for investors. And we are style agnostic, and we believe that will allow investors a full market cycle experience if you adopt one of our funds. If you have any further questions or inquiries relating to the fund, please reach out to John Price at Ely Griffiths Group. He's Head of Client Servicing, and he can be contacted on the below details. Thanks for your time.